In this video, we'll continue to talk about accrued liabilities. We'll focus on compensation. Now, for company, employees' compensation is a type of expense, right? Compensation takes a lot of forms. It can be hourly wages for those contractors, salaries, like I'm getting salaries, monthly salary. We also have commissions for those real estate agents, and then we have bonuses. Now, those investment bankers, which is the future you will have a large compensation to be bonuses, about 40%. And then you have the stock compensation plans, which are usually for at least MD and above, like managing director, all the way to CEOs. You also have pensions. Now, if you pay this compensation by cash, the same period, then that's fine. There's nothing accrued. However, if the employees have provided services but will be paid after the financial statements date, then companies will have an accrued liabilities, right? This is again about the matching principle. You have to match the cost or the expense to the revenue. So revenue is generated in 2020, then your employee salary in 2020 should also be recorded as an expense in 2020, not 2021, even though you're paying it in 2021. These accrued expense, accrued liabilities will be recorded again by adjusting entries at the end of the reporting period prior to preparing the financial statements. Now, an employee should accrue an expense and the related, the company should accrue the expense and the related liabilities for the employee's compensation. Also, not only for the salaries, but also for future absence, such as the vacation pay, sick days, and other future absence if the application meets the following four conditions listed here. Is all the four. So number one is the obligation is attributable to employees' services already performed, right? Can we say that this obligation, our liability, can be attributable to those that have already performed? They have worked, so they earn the vacations. Good. Number two, the paid absence can be taken in a later year. For example, if you haven't taken the vacation in 2020, because of the travel ban, will these vacation days be carried forward to next year? If it is, then this criteria is met. Number three is the payment is probable, and number four is the amount can be reasonably estimated. Well, you may find these four kind of quite familiar. This is exactly the definition of liability, right? Probable is going to be in the future, right? The amount is reasonable estimated. So we'll not talk about the salaries, right? The actual bonuses. It's very similar to the previous interest rate. So that type of journal entry we will skip. However, we'll focus on this vacation, sick days, and other paid future absence. Now you may ask me, how about holidays? How about military leave, maternity or paternity leave, and jury duty? Well, these typically do not accumulate. If you don't use them, you can't use them the next year. So then we don't have the accrued liabilities because there's no like you're gonna do it in the future, right? It doesn't satisfy these the second criteria. So we are not owing you anything and will be satisfied in the future. That's why it's not accrued. Only vacations, sick days, and other forms of future absence will be accrued. All right, now let's have an example of the accounting for paid future absence. We'll start by listing the facts. Davis and Gaddy Chemicals has 8,000 employees. Each employee earns 2 weeks of paid vacation per year. Vacation time not taken in the year earned can be carried over to the subsequent year. During 2021, 2,500 employees took both weeks vacation. That's why they have 0 left. But at the end of the year, they found out that in total, 5,500 employees had vacation time carried over as follows, which is these 2 lines. There are 2,000 employees that have 1 week left will be carried forward to the next year. Well, then the total carryover weeks will be 2,000 times 1 equal 2,000, right? Easy. The rest 3,500 haven't taken vacations at all. They are the most hardworking. Well, that's hypothetical, right? You should take some vacation. Don't burn out. Well, and then, simple calculation, 3,500 times 2, we have 7,000 weeks for the third line. So in total, there is 9,000 weeks carryover weeks for the next year. All right, one more piece of information. During 2021, compensation averaged $600 a week per employee because we need to record the accrued liabilities. This is how we can kind of measure it, right? This is the fourth criteria. We know how to measure it. Each week on average is $600. So then we have that many weeks left, we know the lump sum. Now, for the vacations that have taken, that is the first line here, right? 2,500 employees, they have taken their 2 weeks vacation. And we should simply just do the following. There's no accrued. You either pay cash, usually it's salaries payable, or cash, you pay them. And you record salaries expense for $4,200,000, which is calculated as number one, the first line. They have taken both weeks, so I time 2 weeks. And each week on average costs the company $600. So this is the first line. We also have 2,000 employees that have taken 1 week. So 2,000 times 1 times $600. That's the second line, right? In total is 4.2 million. So we do the following. Next is the adjusting entries. Now we have to kind of acknowledge that there are so many employees weeks that haven't been taken, and we evaluate how much these vacation weeks is worth for the company, and we're gonna do the following. We have to record salary expense because these employees earned these vacation days in 2021. So it's the 2021's expense for the company. The calculation is that we have found out that there is 9,000 total carryover weeks. And I know each week's employees' salaries on average is $600. So we get 5.4 million. Now, there's no cash or no salaries payable. We're gonna do this liability. We record accrued liabilities, and it is the compensated future absences. Lastly, in 2022, right? So just a recap, we have talked about these 2 situations. Now it is the last one in 2022, the next year, when the employees finally take vacations. There may be some changes. Changes will be, for example, employee salaries increases year by year, and that's totally possible. It's very common. But previously, we have recorded liability according to this $600 per week. So we recorded 5.4, right? So this is gonna be first here, 5.4. But however, it's no longer 600 on average per week. It increases to 633.33. This is an average number, so the number may be ugly. And now we have 9,000 carryover weeks. And when they actually happen, it costs the company 633.33 times 9,000 weeks. And that gave us a total of 5.7 million. Well, previously we have a liability of 5.4, and that's not enough. Well, the difference, remember in the middle, when we adjust entry, we record debit salaries expense, right? We still do the same thing. Put the difference into salaries expense. So simply put, if there is no financial reporting period in the middle, what we do is just this one, right? Debit salaries expense, credit cash. Because the financial reporting period is happening in the middle, before we actually pay salaries or employees taken vacations, we have to create an accrued liabilities. And the next year, we're going to reduce these liabilities because they finally taken the vacation. Bonuses. Now, sometimes the compensation packages include annual bonuses tied to performance obligation designed to provide incentives to executive. Well, the most common performance measures are earnings per share, net income, and operating income. Each are used by about like a quarter of the firms having those bonus plans. We also have those non-financial performance measures. Those are not using the financial reporting, our accounting proxies. For example, you see the salary satisfaction, product or service quality, right? Now, annual bonuses are so popular, not just the executive, also some non-managerial personnel also have it. For example, investment bankers, right? Unfortunately, for employees, bonuses often take the place of annual raises of your salary. So when you have a salary raise, this allows the company to sort of increase employee pay, right? Without permanently locking in the increases in salaries. Bonuses are compensation expense of the period in which they are earned. Now, I want to provide a real case example on how Coca-Cola recorded their executive bonuses. This is the proxy statement for Coca-Cola Company. So proxy statement states, if you browse it out, it states the compensation plan for the employees. Now you see there are this table of contents, voting, right? And the board of and committee, directors, compensation, directors' independence, and related person transactions. We also have how does the compensation structure in this part, compensation discussion and analysis. This is the part that where you will see the actual compensation plan. So the CEO of Coca-Cola is Mr. Kinsey, James Kinsey. Let's look at James Kinsey's compensation. Quickly browse down. Mr. Kinsey over here. Look at the structure. First, they have a base salary. For Kinsey, he earns 1.6 million cash as the salary. And then bonuses. So bonuses is related to the performance of the firm, right? First, they have a target. And then obviously, the Coca-Cola firm kind of finished the target, actually overbeat the target by 200%. So then it gives Mr. Kinsey a 3.2 million because of beating the target. And this kind of have a business performance factor of 138%. Let's look at what it means. First of all, what are the targets? Is it really what we talked about in the financial and non-financial one? If we come up, this is the performance matrix about the targets. Targets are informed by the long-term growth target range, okay? Now, over here, the 2019 target for Coca-Cola has two metrics. One is net operating revenue growth. Revenue, definitely an accounting thing. And they also have the operating income growth. The target is 15% for the revenue growth, but actual is 16.5, so beating the target by 143%. Well, then the next one is operating income, right? Target is 11.5 over here. And then actual is 13%, so beating the target. These are exactly what we mentioned, the accounting, right? Does it have earnings per share? Actually, it does. It's on the long-term gain. Long-term plan, long-term incentive annual awards is awarded their performance share units and options. So this is not paid by cash. Instead, they are paying equities. In other words, stock option. You are able to, in 3 years, purchase Coca-Cola stocks for a much lower stock price. Or you can get the performance shares, which means I'm directly giving you shares, stock shares. How about Miss Kinsey?